Welcome to This Explainer. Today, we're diving into how a massive, fast casual brand completely conquered the Indian market by literally breaking all the traditional rules. We're looking at California Burrito, a brand that looked at standard quick service restaurant strategies, tossed them right out the window, and built an absolute empire.
So how exactly do you sell Mexican food in India? It's a fascinating question, right? Because traditional fast food wisdom basically dictates that foreign brands have to adapt if they want to survive. The old logic goes, if you want to sell international food in India, you gotta heavily localize it. Add local spices, create wild fusion dishes, and mold your product to fit pre-existing palates. It's what almost everyone else does. Usually, competitors lean heavily into that localized fusion. But California Burrito's founder, Bert Mueller, he deliberately rejected that approach. In the early days, they actually tested out a few fusion items, but very quickly just dropped them. Instead, they made a huge gamble, focusing strictly on authentic California-style mission burritos, fresh ingredients, and absolutely zero fusion. And wow, did that counterintuitive strategy pay off? We're talking staggering top-end revenues of nearly 337 crore rupees in recent years. They didn't just survive by ignoring conventional wisdom, they totally thrived on it. To figure out how they pulled this off, we're going to tear down their playbook. We'll quickly walk through the anti-fusion success story, hooking the urban professional, the lean marketing engine, the delivery app dilemma, and finally, scaling to 300 stores.
All right, kicking things off with part one, the anti-fusion success story.
Their entire vibe revolves around being honestly good. Instead of mashing up flavors, they obsessed over top-tier ingredients. They went through the massive headache of locally sourcing and even growing avocados, tomatillos, and specific beans right in India. But here's the absolute genius part. Instead of changing the actual flavor, they found ways to explain authentic items through familiar Indian concepts. For example, they framed a traditional tortilla as a corn chapati. It brilliantly bridges that cultural gap without compromising the recipe. You get the real Mexican flavor while leveraging the natural similarities between Mexican and Indian staple ingredients. And just think about the sheer scale they've hit with this method. Over 130 outlets across major metros like Bengaluru, Hyderabad, Chennai, and Delhi NCR. It totally proves that consumers genuinely craved this uncompromised authenticity. They didn't want the food watered down. They just wanted it fresh, fast, and high quality. All that quality translated directly into some seriously healthy business metrics. By keeping ticket sizes super accessible at around 250 rupees and mastering their made-to-order assembly line, they built a highly profitable foundation. We're talking a rapid store payback period of just about 24 months and incredibly high sales per square foot. They basically built a financial fortress before they even thought about aggressively scaling.
Moving right along to section 2, hooking the urban professional.
Instead of chasing the big weekend family outings like most chains do, they zeroed in on a super specific customer profile. They went straight after young urban professionals, Gen Zers and millennials, working right in the heart of major tech hubs. These are folks looking for a relatively healthy, protein-heavy, individual meal during a crazy work week. They want something quick, customized right in front of them, and fast. If you're building a brand today, take notes here. California Burritos didn't try to please everyone. They perfectly positioned themselves for the rising individual meal occasion in urban India. And the result of that hyper-targeted approach? California Burrito isn't just a place to eat. It's a full-blown habit. The repeat visit rates are insane. Over half of their customers, 56%, drop by at least once a week, and 80% visit at least monthly. When your product fits that seamlessly into a professional's weekly routine, you generate organic loyalty that you literally cannot buy. Okay, let's jump into section 3, the lean marketing engine. Their marketing evolution is pretty wild, honestly. From their launch in 2012 all the way up to 2020, they spent practically zero on marketing. Zero. They relied entirely on word of mouth and planting themselves in high-visibility tech parks. Paying rent was effectively their marketing budget because it captured massive office lunch traffic. But then, post-COVID happened. Delivery suddenly surged to as high as 90% of their business for a bit, which forced a huge pivot into digital marketing. Today, their engine is incredibly sophisticated.
What's really impressive is that even today, with a marketing budget still sitting at a super lean 4%, they run on four hyper-efficient pillars rather than dumping cash into TV ads. First, they still treat prime real estate as top-of-funnel awareness. Second, their Gen Z digital game is incredibly strong, lots of Instagram memes and a playful personality. Third, they drop viral limited-time offers, like when they sold their entire menu for just 100 rupees to celebrate their 100th store, which created lines around the block. And fourth, founder-led visibility. Burt Mueller is always out there on podcasts, giving the brand a real human face.
I mean, get this. They posted one simple behind-the-scenes reel on Instagram showing their tomatillo sourcing, and boom, 400 farmers reached out wanting to work with them. It's PR and supply chain building happening all at once. That is the kind of authentic, organic buzz that massive ad budgets just can't manufacture.
Which brings us to Section 4, the delivery app dilemma. Right now, a whopping 50 to 70% of their total sales are routed through delivery platforms like Swiggy and Zomato. Modern urban consumers demand convenience, and California Burrito absolutely delivers it.
But it's a total double-edged sword, causing a serious margin squeeze. Yes, the platforms provide massive reach and are absolutely essential for their core demographic, but those commission fees, they can chew up to 25% of a sale. That puts a ton of pressure on those beautiful unit economics we talked about earlier.
So how do you fight back? Well, they're aggressively pushing to get customers back into the stores. Dine-In utilizes their real estate investments properly and, crucially, protects their margins. They're heavily investing in digital marketing to build direct brand loyalty so people seek them out directly, while still making sure their ratings stay sky high on the delivery apps to keep that organic algorithm happy. And finally, let's look ahead in Section 5, scaling to 300 stores. As they professionalize and gear up for this massive 300-store milestone, the opportunities are huge. We're talking about building out sophisticated loyalty apps to bypass those delivery commissions entirely. They can deepen their engagement with Gen Z and Gen Alpha online, carefully expand into massive new markets like Mumbai, and really amplify their farm-to-table story to push a premium feel in an increasingly health-conscious market. California Burrito is a masterclass in disciplined, product-led marketing for sure. But here's the big question to leave you with. As this scrappy anti-fusion company morphs into a giant corporate machine chasing an IPO and 300 locations, will they be able to protect the grassroots quality and the founder-led culture that made them a habit in the very first place? It is the ultimate test for any high-growth brand. Thanks for joining me on this explainer, and keep questioning the conventional wisdom.